Go back to the PowerPoint. Stock dividends we won't do a whole lot with, like you won't be tested on them or anything, but we'll talk just briefly. Again, we could declare a stock dividend instead of a cash dividend. The reason, again, that we might do this is we might want to keep our stockholders happy. You know, Danielle was asking, well, why would we buy stock if we knew we weren't getting dividends? So at some point, you know, we might want to say, okay, our company's doing pretty well, but we're still growing, but we want to keep our stockholders kind of invested and happy. We don't want them all jumping ship, right? Because the more people we have that are happy, the higher our stock prices stay. So we could actually do a stock dividend. So a stock dividend obviously is not going to affect our cash situation. So maybe we had, you know, the last couple of years have been fairly profitable, but we've been using our cash to grow. Okay, so we've been using our cash, our profits, we've been putting it back into the business. So we could declare a stock dividend because then it's not affecting the cash, it's just affecting our retained earnings. So we still have to be profitable in order to, you know, declare a stock dividend. We just could have lower cash reserves, okay? So stock dividend affects only stockholders' equity, okay? It's actually going to be transferred from retained earnings to paid in capital, okay? To take care of that. So stock dividends are usually only declared on common stock and issued to common stockholders. These are not cash dividends, so preferred stockholders do not receive stock dividends. Okay. So stock dividend does not change the assets, the liabilities, or the stockholders' equity. It just moves it around a little bit. Okay. It doesn't change their percentage of ownership necessarily either. You know, all things, the percentages will stay the same because everyone's kind of increasing. Does that, you know, when we declare a stock dividend to common stockholders, you know, I'm not going to go from owning 20% to 25% of the company, but my amount of vested interest does go up. Okay. We're not going to go into, you can kind of look at this. It's just kind of showing you how it doesn't change the ownership, but we're not going to, I'm not going to require you to understand all of that. Good old math, right? But that's declaring like a 6% stock dividend. So it's just showing you, we are increasing the total number shared and the total, you know, number issued, okay? But the ownership stays the same there. The last form of stock that we talk about in this chapter is treasury stock. So treasury stock is stock that we buy back of our own stock, okay? So we've issued it and then we reacquired it, okay? So we've repurchased our own stock. We may do that to then resell to employees, you know, as a stock option in the company, maybe as a benefit to allow our employees to own part of the company. We may use it to issue bonuses to employees. Some companies will do stock bonuses. Or we may do it just to support the market price of the stock, okay? So again, you know, when there's buying and selling and trading going on, you have activity, it's keeping your market price steady. So we might purchase shares of stock. Maybe there's shares available, and so we're like, well, we'll purchase them to keep that price steady. So basically with treasury stock is going to get a debit. It's a debit account because we own, it's shares of our own stock we own. So it's actually reducing, you know, our total stockholders' equity because we purchased, bless you, we purchased our own stock. You know, we're going to debit treasury stock and credit cash when we purchase treasury stock. So it's showing us, let's see, a corporation has the following capital. So we have common stock, $25,000 or $25 par, $500,000, and then paid in capital in excess of issue price is $150,000. So all total, we have paid in capital of $650,000, and then we're going to look at some treasury stock transactions. So on February 13th, we purchased 1,000 shares of our own common stock at $45 per share. On April 29th, we then sold 600 of those for $60 per share. And on October 4th, we sold the remaining 400 shares for $40 per share. So just like common stock, we have to keep track of that value that we bought and sold it for. So February 13th, we purchased 1,000 shares of Treasury stock at $45. That's just a simple 1,000 stock shares times $45. So again, we debit Treasury stock and credit cash because we're purchasing our own Treasury stock. What happens next is on April 29th, we sold 600 shares for $60. So we actually gained money, right? We sold it for more than what we paid. So we sold it for $15 more per share. So cash gets debited the full amount of cash we received, 600 shares at $60. And then we really treat this like a premium, you know, just like we would like a premium on common stock, only we're selling instead of issuing. So Treasury stock gets credited for the initial value we paid, $45 times 600. So Treasury stock gets credited because we sold it, it's going away. 600 shares at $45. And then the difference, the $15 difference per share, gets credited to paid in capital from sale of Treasury stock. Okay, so that's increasing our paid in capital. It's increasing our retained earnings when we sold it for a gain. And that's a common thing to happen. We might buy it when prices are low, and then we'll try to sell it when the price goes up again. So it's a way of making a little money on our own stock and increasing stock prices a little bit. On October 4th, though, we sold the remaining 400 shares at $40. Well, obviously that's a discounted amount because we bought them at $45. So 400 shares at $40, we received $16,000 in cash. Well, we lost $5 per share, so 400 times 5, we debit the paid in capital $2,000. That's reducing our total profits, okay? And then Treasury stock gets credited for the $45, 400 shares at $45. Okay. So the only thing tricky when we deal with Treasury stock is right here we had paid in capital from sale of Treasury stock of $9,000. If when we sold the remaining shares, maybe our loss was more than $9,000, you know, we can't debit paid in capital more than what its credit balance is. So we're going to look at that probably Thursday when we do some examples of what happens, because that's the only tricky part of Treasury stock is when we sell for like a loss, we can't debit the paid in capital account for more than its balance. So if this amount was like $10,000, we'd have to debit paid in capital $9,000 and debit retained earnings the remaining $1,000. Okay, but we'll look at that. I'm going to kind of give you a heads up on that. So we have to keep track of that paid in capital account, okay, because it can't really go negative, okay. But we'll look at that on Thursday. I have an example of that. And it's kind of what that is talking about. No dividends are paid on Treasury stock. It's stock we own of our own stock. So we don't pay ourselves dividends of our own money. It wouldn't really make sense, right? It would just be like moving it around a little bit. So we don't earn dividend revenue on our own stock. We could earn dividends on stock that we owned in other companies, though. Okay, if we had purchased other company stocks, we might have dividend revenue, but not from our own stock. Okay, any questions on that? Okay, well, last thing we're going to do is do some entries on Treasury stock. So if you go back into the practice, I think it's the third one. Yeah, the third one, we are going to look at Treasury stock. Okay. So it says on May 27th, Hydro Clothing Incorporated reacquired 75,000 shares of its common stock at $8 per share. So let's do that transaction first. So we purchased 75,000 shares of our own stock at $8 per share. So what do I debit and credit there? Very good. I'm going to debit treasury stock and credit cash for how much? 600,000. Good. So 75,000 shares at $8 a share. The 600,000. On August 3rd, Hydro Clothing sold 54,000 of the reacquired shares at $11 per share. So did we sell it for more or less than what we paid?
More than we paid.
More. Very good. Yeah, we sold it for $11 and we paid $8. So we've sold it for more. So how would I journalize that? What would I debit? Cash. Good. For how much?
$594,000.
Very good. 594,000. 54,000 shares at $11 a share. So 594,000. And then what do I credit? Treasury stock? I heard you whisper it. So. I'll take it, right? Treasury stock gets credited for how much? How much would I credit treasury stock for?
432,000.
Very good, 432,000. So treasury stock gets credited at the initial price. So 54,000 shares at $8, okay? That original purchase price. And then what else do I credit?
Paid in capital from sale, treasury.
Very good, paid in capital and with enthusiasm. Paid in capital from sale of treasury stock. And again, that's just the difference. You could just take your cash minus your treasury stock. And what, 162,000. 162,000. And then our last entry, November 14th, we sold the remaining shares at $7 per share. So did we sell them for more or less than what we paid for them? Less. Good. We sold them for 7 instead of 8. So on November 14th, how much cash did I receive?
147,000.
Very good. 147,000. So it would have been the remaining shares, which is what, like 21,000 shares at $7 per share. And then here, again, we're losing money. So we sold it for $1 less per share. So we had 21,000 shares. We sold it for $1 less per share. So we lost 21,000. Well, we have plenty in our paid-in capital from sale of treasury stock to, kind of eat up that loss. So we're going to debit paid-in capital, 21,000. Paid-in capital from sale of treasury stock. So as a $1 difference, we had 21,000 shares at $1 loss each. That's where I'm getting the 21,000. And then again, you can add them up, or you can credit treasury stock 21,000 shares at $8 per share, or you can add to get a credit to treasury stock of 168,000. Okay. So again, treasury stock really is just kind of reversal entries from issuing common stock. When we purchase treasury stock, it's a debit to treasury stock and a credit to cash. When we first purchase it, it's just always at whatever value we paid. And then we use that value amount when we sell it to determine if we sold for a loss or a gain. Okay. And then that goes into that paid in capital from sale of treasury stock. Any questions? Yes. Well, we'll probably finish those up on Thursday. So yeah, because I do have some to go back through, and we still have some practice to do. So yeah. Which one is it on though? Well, I meant, wait, what's the question over though, just to make sure? Okay, yeah, I think we'll go over that kind of briefly on Thursday, so should be good. Any other questions? Okay,